And good afternoon, financial professionals. My name is John Florence. I am Senior Vice President of Marketing at E4 Insurance Services. We welcome you today to the BREW, which is building relationships every week. Thanks so much for tuning in today. And for those of you joining us for the first time, we like to start off the BREWcast by celebrating some of today's national days. Today is National Red Cross Giving Day. The Red Cross movement, as you may know, was begun in 1863 by Swiss businessman Henri Durand, who was appalled by the ravages of war and what little was done to alleviate the suffering of combatants and non-combatants alike. In 1881, Clara Barton took up the cross, so to speak, in the United States and established the American Red Cross. Now, for more than 140 years, the Red Cross has provided life-saving services on battlefields and disaster areas around the globe. So whether it's blood, time, or money, the Red Cross welcomes your donations. Today is also National Goof Off Day, reminding us that all work and no play makes Jack a very dull boy. It's okay to find some time to leave it all behind and do nothing. And if the weather were a little bit nicer outside, I'd probably slip away to practice my golf swing right after the BREWcast today, but alas. And lastly, today is Gryffindor Pride Day. The legendary House of Gryffindor was formed over 1,000 years ago. Counts among its members such luminaries as Godric Gryffindor, Albus Dumbledore, Hermione Granger, and of course, the boy who lived himself, Mr. Harry Potter. For all of you Potterheads out there, today's your chance to sport the scarlet and gold of your favorite Hogwarts house. 10 points for Gryffindor. Before we get started with today's guest, I'd like to remind you all to feel free to use the chat box to share your thoughts or ask questions of our guest today. Also, all attendees are in a drawing for a CE voucher and a Starbucks gift card, and we will be announcing the winner at the end of the broadcast. Now, since the Fed began its most recent round of interest rate increases just over a year ago, fixed annuity products have seen the biggest inflows in the past 20 years across most carriers. All these interest rate movements have many of our advisors and clients wondering whether we'll be seeing even higher fixed annuity rate offerings in the weeks and months to come. To help make sense of all of this confusing activity, today we welcome Dayna Parks, who is the Director of Fixed Annuity Product Development at Nationwide. Dayna, welcome to the BREW.
Hi, thanks for having me.
Sure. So within the hour, maybe even as we are speaking, we're expected to hear from Chairman Powell about whether the Fed rates will be advancing or retreating. We really don't know in light of everything that's been going on in our banking situation. Let's not call it a crisis right now. Does this mean that tomorrow we'll expect Nationwide's fixed annuity rates to change?
Rate discussions were happening yesterday and today. We are kind of waiting to make our final decisions until we do hear from the Fed today. The environment did challenge rates a bit, and the supportables on those rates here in the last week and a half, things had been looking really good. Things went down quite a bit within the last, 7 to 9 days. So we could see some changes. And as you mentioned, that is a direct impact of the fixed rates. And I think, we'll get into a little bit more of why we see those changes and how those things kind of impact the pricing of fixed indexed annuities.
That sounds great. Why don't you share with us a little bit about how Nationwide and you particular go about making these decisions and what kinds of things impact them? And I know you have a couple of slides that you can share with us.
Yeah, so I will pull up those slides. So really, to kind of understand some of what's happening and how it impacts rates, we want to talk through both what we do with initial premium and how that kind of helps to set rates, but then also why you might see a little bit of a difference when it comes to renewals versus new issue. I think that's, some of the questions that come up a lot is sometimes people expect to see when their renewal comes up that if perhaps current new issue rates are higher because rates are higher, sometimes people are expecting their renewal rates to pop up, and that's not the case often, and that's because of how the investments are done underneath. So if we take a look at really what we do, you can kind of describe this in a couple different ways. And what we've sort of found I think for clients, what might be the easiest way to think about it is sort of two separate buckets. Now, we don't actually separate the money out when we get initial investments, and we don't actually separate it out into two separate buckets. But what we do have is, a portfolio of bonds and long-term instruments that we use to cover the guarantees on the product. So those minimum guarantees, your standard non-forfeiture rate. So that 87.5% of premium that accrues at now 2.85%, we cover that with longer term investments. And those investments, when we make them, they are made basically based on the weighted average life of the contract. So we essentially try to match up the bonds that we're buying to the CDSC period on the contract. So with Peak 10, it's 10 years. So we're looking at weighted average life of 10 years. So we're typically buying 10-year bonds, which means for Peak 10, a lot of the changes that you see to the 10-year treasury will have an impact. Some of our shorter term contracts are maybe a little bit less based on changes to the 10-year treasuries and a little bit more directly related to 5 years, which means we're seeing some interesting things right now with some of the, slight inversion to the yield curve that we're starting to see.
Let me pause you just for a second.
Yep.
Does that explain why we're seeing, in some instances, some of these shorter surrender periods and shorter guarantee periods that have really high rates? And then even as you move out, where one would expect to see a higher rate for being able to hold an instrument for 5 or 7 or 10 years, those rates are even lower than the shorter ones. Is that what you're talking about? Is that the inverted curve that's causing that?
Yep. Yeah. As we get closer to, a potential recession, you start to see the yield curve start to invert slightly. And that's where people have more faith or more confidence in shorter term investments versus longer term. So you're able to get higher return on things like 2-year bonds, 5-year bonds versus 10-year. So that's why we're starting to see some of that. I mean, we've seen some of that impact even some of our MVA versus non-MVA. I don't think we saw it come through on Peak 10, but we saw some interesting things happening with where normally you would expect the MVA rates to be higher on a product than the non-MVA. We actually saw some instances where just how the numbers worked out, the non-MVA rates were actually higher, and it's got a lot to do with what's happening with the yield curve right now.
Thank you. And for those people who may not be intimately familiar, MVA stands for market value adjustment on the annuity. Can you give a brief explanation of how that works? Yeah,
really, that's just we just kind of index off of the corporate bond index, Barclays, and it's really just an adjustment up or down based on what's happening with interest rates that we can make on a contract when a withdrawal is made. And that would be a withdrawal within the CDSC period. Once you're outside of the CDSC period, those MVA, charges don't apply. So it's just an adjustment up or down. And I believe I'm going to mix this up here possibly, but it works in the inverse. So when interest rates are down, when the bond that we index against, or the index that we kind of gauge it against is down, like the MVA charge might be positive on your account, versus if the index is up, there might not be an MVA charge. So it really kind of depends what's happening. Just because you have a product that has an MVA doesn't always mean that you might get an MVA charge on it on a withdrawal. So
that really relates only to withdrawals that are over and above the maximum
free withdrawal amount.
Or within the surrender period schedule.
Yeah, anything that would incur a CDSD charge, if you're in a state that also has MVA, would incur an MVA charge. So
you talked about the main bucket sort of going to, the various assortment and portfolio of bonds and fixed instruments that you're using to provide your guarantees. Talk a little bit about your options budget and how that works.
Yeah. So if you think about it in the context of two buckets, like most of the premium is going to support that longer term portfolio, which covers expenses, the guarantees on the product, any profitability targets and things like that. And then what's left over essentially is really, and the yield from that long-term portfolio is support. It creates an option budget. So what's left over is the amount that we have to spend to buy options to cover the performance of the index strategies that are selected. And so that's really where this is where you really start to get into what impacts, what we can set for caps and participation rates. So your option budget is what's left over from that long-term portfolio. Now, if you think about that, like I said, that long-term portfolio is usually based on the weighted average life of the contract, which means we made a 10-year investment typically when somebody bought a peak 10 contract. That means that option budget, it's not completely fixed, but it is pretty steady throughout the life of, throughout the CDSC period. So your option budget stays relatively the same. There can be changes depending, when things are happening like they're happening right now. We do start to see, yields can go up and down a little bit on those longer term investments that we've made. And so some of our estimations for what we may get from those longer term investments can change. So those can vary just a little bit. But typically the option budget is relatively steady. And then where you start to see more of the fluctuation is with option costs. And that's really just, if we go out to the market, what is it going to cost us to be able to hedge or buy the derivative to hedge that index performance? So usually, you can see here, if you've got a higher option budget, all things else held the same. If you got a higher option budget, we're probably going to be able to provide higher caps or higher par rates because we can essentially buy more options. Same thing happens if you've got lower option costs. We might be able to, offer higher par rates, higher caps, just because we can buy more options. So if we go, kind of look, and that's really on initial. So that's the two factors that really influence the pars and the caps. And that's where you start to see at renewal. This is why you start to see sometimes renewal rates will go up or down a little bit, is because the option costs can change. Like I said, the option budget will typically stay pretty steady. There will be some fluctuations, like during COVID when the market really bottomed out. We did see some of the option budgets take a big hit in some of our products. And so that changed, what we were able to offer on renewal. I think a lot of companies had the same experience. But when you look at the option cost, when it comes to renewal time, depending what's happening in the market at the time, our costs can be higher or lower. And the cost of options are really driven mostly by the risk-free rate of return, a combination of that and the volatility of the index and the market at the time. So option prices are really what's driving changes from month to month, what we can offer. So right now, with all the volatility in the market, option costs are going up, particularly on things like the S&P that are very equity based. And so that's where you'll see rate changes and why rate changes are happening, because our option budget didn't really change, but now we can't buy as many options with the amount that we have available. So that's really why you see variance from month to month. And then at renewal, why renewal rates don't match up to, current issue rates is because it goes back to that same thing where our option budget was based on the long-term investments that we were able to make when the contract was purchased. So those economics drive the rates. And so that's why you don't really see renewal rates match up to new issue, is because we are funding that with an option budget that was based on the bonds and the longer term instruments that we were able to purchase at the time that contract was opened. So
let me ask you what might be a newbie kind of question, but I know that probably some of our advisors maybe think about this way. when you're talking about, sort of the pricing of these products, are you taking an individual person's premium? Let's just say, for example, I'm a, Joe retiree out in the market and I want to buy a peak 10-year annuity and I give you $100,000. Are you taking that individual $100,000 and then placing that into the market, or do you do it in bigger tranches or
Yep.
or sort of blocks of
Yeah.
capital that you have, and that's what's driving the pricing?
Yep. We really look more at blocks of business and tranches. And that's why, now we don't wait until the end of a month to invest everybody's money that we got through that month. But that's kind of why you will see, we set rates typically monthly, and we try not to change them mid-month if we can help it. But no, we're not buying an individual bond or a long-term investment for every single contract that comes through. We pool that together and purchase. Now we do pool it based on type of contract. So like peak 10, because it's a weighted average life of 10 years, those are going to go together. We have some bank products, peak products that are, a 5-year or 7-year CDSC. The assets from those contracts are invested separately because they're going into more of like 7-year and 5-year, kind of like bonds and different investments to match up to that.
Fascinating.
So, yeah.
So, going back to the renewal thing that you were talking about before.
Mm-hmm.
So I know a lot of both clients and advisors sort of wonder about that. Can you talk a little bit to Nationwide's renewal history and sort of, you
Yep.
mentioned a little bit what drives that? It's the changing economics that are changing the cost and pricing of the options budgets that you have. But most people, when they're getting into, say, an indexed annuity, are buying into a strategy that is typically 1 or maybe 2 years long. And then they're at risk of the rates perhaps being different. But what is it like, and how has it been for Nationwide, if you can talk to that as far as renewals?
Yeah. And so that really goes back to, like you said, the options. So we purchased the option budget is based on CDSC, so 10 years, but the option budgets are purchased to really match up to the term. So the options that we're purchasing are 1 year, 2 year, depending on which account, option has been selected. To try to offer them longer term, it's going to cost more. We're not going to be able to offer higher rates. So doing it 1 year, 2 year, shorter durations in this situation allows us to offer more competitive caps and pars. Now, because the option budget is relatively set, we are typically able to maintain pretty consistent rates. And that's always been Nationwide's philosophy. And our goal is to keep those rates as close as possible to the initial issue rates as we can. And we really stand by that. We're a company that is there to do the right thing by the client. That being said, we talked a little bit about COVID and what happened to option budgets during COVID because the market just hit such a low. There were instances where we had to lower those option costs a little bit. And a lot of that, the option budget lowered and we had to kind of start issuing lower rates. Some of the renewals took a little bit more of a hit than we normally like to see. Even then, I don't think it was as much of we didn't decrease even as much as some of our competitors have. But yeah, typically we're talking, we really try to stay, a lot of times, you might see it go up or down, 0.1%. or something like that on your, and it's not, in pars are a little bit different, but still try not to go up and down a lot on pars. Nationwide really tries to be consistent. And one of the things that we are looking at is trying to get a view now that we've had peak 10 in market for a little bit longer to kind of see what the renewals look like on peak 10. Obviously people who were in par accounts that are 2-year terms. Those we're just starting to see renewals come through for that now. So there's not a ton of peak 10 specific renewal history, but we do have renewal history on some of our other FIA products, and it's been pretty positive. Like I said, COVID kind of threw some things for a loop just a little bit, but overall the renewals have been pretty consistent. And then to kind of get into that, option budgets stay fairly the same. A lot of times what changes the renewals is option costs changing. And that's where then you might also see a little bit of a difference between just straight equity-based indexes like the S&P versus some of the newer proprietary indexes that are out in market, and what you might refer to as a smart beta index. You might see some differences in consistency with renewal rates there. And a lot of that comes down to there's 2 factors really that drive that. That's the volatility of the index itself, as well as the option costs. So and whether they've been negotiated. So the S&P, it's those option costs go up and down a lot more just because that index is more volatile. A lot of these newer indexes that are out have methodologies built into them that are designed to keep the volatility within 5%, within 10%, whatever is the stated volatility of that index. So with a much smaller volatility, the option costs just naturally aren't as high on them. And so your option budget goes a little bit further. The other thing that happens a lot of times, particularly if we are working on an exclusive index with a company, which is, what all of the indexes within peak 10, other than the S&P and the S&P daily 5%, a lot of times we will negotiate our option costs. So we're able to kind of lock in that option cost pricing up front. And that's where then a lot of times on renewal, you shouldn't see too much change other than where maybe our option budget decreased based on some economic factors. But like I said, option budgets stay fairly stable, barring big events.
Fascinating. It's great. And really very, very interesting. Anything else that you would like to share with us today?
No, I mean, I think the new indexes that are out are an interesting topic, but that's a lot to dive into.
Well, maybe we'll have you back sometime soon.
Well,
and we can talk about
me
that.
or even bringing in some of our index partners from BNP, from Alliance Bernstein, they can come in and kind of give you a 15-minute overview or 20-minute overview of how their indexes work. I mean, all of those newer indexes, the basics are the same. They've usually what's different about them or more different about them is the equity selection methodology, and everybody's trying to find a unique way to pick the best equities, get the best return. And then they're all typically, then they've got kind of a volatility control methodology or mechanism in place where they're able, and a lot of them, most of them do it daily, they're able to shift money out of that equity component and into some of it's fixed in, some of them vary between fixed income, like 10-year and or 2-year treasuries, depending what's going on, and sometimes right into basically straight up cash if things are getting really bumpy.
Yeah.
So, I mean, overall, that's the gist of kind of what they're all doing, but it's very interesting. We see a lot of companies coming in and showing us new indexes with new equity selection methodologies. And so it's a very interesting space right now, but I know it can be overwhelming because there are so many. So definitely let us know if there's any interest in getting our index partners in.
I think there would be a great amount of index, particularly because as we move to questions and we wrap up the session today, one of the questions that came across is on the peak 10, you were mentioning the BNP Paribas, I think H factor, global H factor index.
Yep.
And how can a client end up with a cap rate that is over 300%? And in some cases, you see them going as far as 400. If the index itself can only give what the index gives.
Yeah.
So what is it that you guys are doing there?
Yeah, absolutely. And that really comes down to kind of going back to what we talked about, the option budget and the option costs. And it's really the ratio of our option budget to the option cost. So my husband is a derivatives trader, and he's going to kill me for saying it this way because it's not how it really technically works. But if you kind of think about it, like if we have a 10% option budget and we go to market, and right now the market is saying, you know, like if you go out on the live market, free market, if it's saying that 5% will get you 100% of whatever that index is doing, well, we've got 10% to spend. So we can essentially buy 2 options to support that one account, which gives you the 200% participation. Now, it's more complicated than that. It has to do with the amount of notional that you put onto your call option and everything. But I think the easiest way to really just understand it is it's really just the ratio of the cost to the option budget that we have. And essentially, if it costs $5 and we have 10 to spend, then we can buy 2 of them.
That's great. Listen, I think we will need to try and take that up on a different edition of the Brewcast. We would very much like to take you up on your offer to do that. I think it's a fascinating topic for us. So thank you so much for the input and for sharing that. As we wrap it up today, I would remind all of the participants today that all of our Brewcasts and our entire library is recorded and shared on our Brew blog, which you can access at our website, e4.insurance, or on our YouTube channel. Just Google YouTube and E4 Insurance Services, and you'll get the entire library. Now, as I mentioned, we do have a giveaway, Dayna, and I'd like you to pick a number between 1 and 25, if you will.
All right, we'll go with number 12.
All right, number 12, and number 12 is Joe Peshanovsky. I'm not sure if I'm pronouncing your last name correctly, but something close to that, I hope. We'll be in touch with you, and you just won a Starbucks and a free CE card. So our group will be in touch with you about that. So Dayna, again, thank you for coming on to the Brew. We look forward to having you again in the future. And if all of you would be so kind as to join us next week, we'll be welcoming back Dave Sawzek. Dave will be talking to us about non-qualified defined benefit plans as a way for companies to offer mid and long-term incentives for executives based on the organization's growth. Join us to learn more about these kinds of plans and how many companies are using life insurance to fund them. My name again is John Florence. We welcome and thank Dayna Parks once again for being here today, and we'll see you next week on the Brew.